Hi, I'm Taylor Mammen from RCLCO Fund Advisors. I'm the CEO and have had the opportunity to build this business within the RCLCO companies. RCLCO itself has been around for almost 60 years, is considered a thought leader in real estate economics and management consulting. And we had the opportunity to build RCLCO Fund Advisors, really coming out of the great financial crisis as institutional investors sought new approaches to invest in real estate. In particular, these institutional investors were interested in exploring the degree to which they could go more quote unquote direct in terms of their real estate investments. Direct means a lot of different things to people in the real estate space. I think it means everything from co-investments or sidecar investments along commingled funds, all the way to direct investments in real estate assets, ownership of operating companies, and so on, and really everything in between. And in the past several years in which we've been working with institutional investors, we have really helped them do all of those things as there are fairly clear advantages to doing so. They include having greater discretion over your investments, having greater transparency in terms of their performance, and oftentimes benefiting from superior economics as the LP, as there might be fewer layers of oversight and groups that therefore need to be paid fees and promote and so on. At the same time, there are costs and challenges associated with going direct. It requires expertise, and therefore staffing is vital, something not a lot of something many institutions have challenges doing. It also can lead to, well, let's just say, awkward conversations as the institutional investor is now involved in the serious detail that's associated with real estate investing, the challenging conversations that need to take place, as well as the crazy things that happen within the buildings in which we live, offices we occupy, and everything else. And so it's important that institutional investors have that perspective when considering going direct. When investors are considering a direct program, I think it's important to really evaluate both the capabilities and capacity of their staff, as well as the third parties that work with them, whether they're consultants or advisors or even managers themselves. As taking on a more direct role, retaining discretion over investment decision-making requires that you both have the expertise to make those decisions, but also that you have the capacity to make the decisions, that you're able to conduct the analysis, underwriting necessary to be able to make a good decision. I think that has meant that when starting a direct program, investors have tended to begin in those areas where they have the greatest degree of comfort, whether that is in terms of property types with which they feel familiar and have some expertise over, and or risk profile. It's probably more likely that you begin a direct program with a core portfolio, or maybe even a build-to-core portfolio, but fairly straightforward types of investments, than doing something more challenging. Our clients over the past 10 years have generally moved along that path from relatively straightforward joint ventures, separate accounts, to much more complicated transactions, including operating company acquisitions, direct investments, and so on. One of the questions that we oftentimes get is, how big does a real estate portfolio need to be in order to benefit from a direct portfolio, of a direct approach to investing? And it is an important consideration. I think what we typically look at, and there's no science around this, but a good rule of thumb is to have at least $1 billion in real estate NAV is probably necessary in order to ensure that the direct investments that an investor is making don't have excessive concentration, aren't simply too big, and therefore driving returns excessively over time. But as you start smaller, perhaps the direct types of investments look more like smaller co-investments. Those aren't going to be too concentrated or too meaningful. And as a portfolio gets larger, certainly there's plenty of room for much greater variation in terms of the direct types of investing that would be done, including direct real estate investment into the asset themselves, as well as operating company investments and so on. I've talked a little about the requirements and keys to managing a portfolio like this already, but it's important to reiterate that it really is important to ensure for an investor to ensure that they have the capabilities and capacity, whether in-house or externally, to be able to take on the discretion that they are hoping to benefit from by going direct. That's an opportunity that we've frankly taken advantage of over the past few years to act as an outsourced real estate department on behalf of institutional investors who want to benefit from the clear benefits that come from investing directly, whether it's transparency, discretion, and/or superior economics, but also recognize that they need boots on the ground, they need expertise, and they just simply potentially need more hands and feet to do the work as well. So happy to talk to anybody that's exploring this opportunity. I think we've seen enough of the challenges and opportunities associated with it to learn a lot of lessons, and happy to share those with others.